But really makes you angry when you read about, say FTX that collected billions and billions of dollars, but never bought the Bitcoin, actually. So why is this a problem? If FTX stole billions of dollars in a BlockFi and Voyager and Three Arrows and Celsius and Terra Luna, if all of those ecosystems basically collected people's money and then lost all the money, then people that legitimately wanted to own Bitcoin had their money stolen from them. We know they gave them billions and billions of dollars of credit, right? Maybe up to $10 billion of credit.
Bitcoin advocate Michael Saylor was on the George Gammon show where he gave his thoughts on Bitcoin and the crypto markets. He explained that in the Western world, Europe, and the developed nations, Bitcoin is a strong luxury asset, a digital gold, a store of value, an opportunity to make money. However, in many less fortunate countries in the world, where the currency is devaluing due to hyperinflation, Bitcoin is a lifeline. In other words, countries where the local currency has been devalued against the dollar, crypto is viewed as a need-to-have investment, whereas in the developed world, it is just seen as nice to have. Saylor believes that most investors are looking at Bitcoin from only a Western angle, but the real value in Bitcoin is for the less fortunate countries where people can own Bitcoin and their wealth is preserved, instead of their fiat currencies being deflated due to inflation. Here's more of what Saylor had to say, but before we do that, if you enjoy finance videos, please support the channel by liking the video, subscribing, and dropping your questions or comments below.
If I were to go to a bank and say, I have some locked MicroStrategy stock, will you loan me money against it? They would say no, zero. If I went to them, zero, right? The answer, by the way, to the question is a disinterested CEO of a crypto bank that was honest and competent would have lent Alameda somewhere between $0 and $10 million. Like, the number is not one order of magnitude less. It's not even two orders of magnitude less, right? It's somewhere in the range of 3 orders of magnitude less. If you were honest and competent, you would basically say, well, what is 5% of the honest trading liquidity in the token? If the thing trades 100 million a day, but 80 million is wash trading, there's 20 million a day. Well, how much of that is trading on another exchange, not your own? Oh, 3 million a day. Okay, so $3 million of this stuff trades on another exchange. Can I trust that one? No, they're not. None of them are regulated. Okay, how much trades, on any regulated exchange? Well, of course, none of it, right? But let's say I threw out the issue of a regulated, transparent exchange. I just said, well, how much trades on an exchange other than the one you own? 10 million. Okay, I'll give you 10% of that. I'll give you $1 million of collateral value. Okay, how much could you borrow against $1 million in collateral? Well, the max is 50% loan to value, 50. So I will give you a $500,000 loan against $8 billion of FTT token. That's the right answer if you're honest and competent. So obviously that didn't happen. The reason it didn't happen is because you had 3 related parties all terminating with one boss, and the one boss was not honest, not competent, and not disinterested, right? A biased, dishonest, incompetent person. Okay, what could go wrong? Well, when you have 3 related parties and a biased, incompetent, dishonest person, what can go wrong is the entire thing gets burned to zero. And is that likely? Yes, highly likely. It's not even just what could go wrong. It's highly likely. That's the reason there's a stigma attached to related party transactions. You would never want the CEO of a bank to be issuing loans to a private company that they owned, right? I mean, like, if it turned out that the CEO of JP Morgan was issuing billion-dollar loans to Jamie Dimon, real estate development company, jointly owned with him and his wife, right? People would just lose it for obvious reasons. no one has credibly documented that there were meetings. We know that there was a calendar entry where someone that worked for Gensler might have had a meeting, but we don't know any. I think I've read that there were many, many more meetings with the CFTC than the SEC, and many, many more with politicians. But we don't know the content of any of those meetings. No one has made that public. But what is your question?
Where were the regulators? It seems to me as though, like you said it before, were they sitting on their hands? Did they know? Is there more to this story?
The regulators it seems like they just don't really want to, they don't feel that they have the authority to regulate offshore entities, right? I mean, that's been the big blind spot.
Because he had it all registered in the Bahamas.
Right. I mean, FTX was in the Bahamas. And so there's this vacuum of power, right? A blind spot where the U.S. regulators don't feel like they have authority to regulate offshore entities. And the action they've taken has been via civil enforcement actions, which are very slow and very expensive, like take years and years and years. And so they have pursued a number of entities via civil enforcement slowly, but they haven't really laid out any global framework for digital assets, and they haven't pursued offshore entities. They haven't even really pursued onshore entities that aggressively. So there's been a lack of effective enforcement, I think you could say, and a question about who should take leadership of it. But Congress has been mired. They haven't passed a law. They couldn't pass a stable coin law. They haven't passed it. There is no law or clarity with regard to how do you register a digital commodity? How do you register a digital security? How do you register a digital currency? How do you register a digital token? Right? There's not even a definition in law of what is a digital. If I said define a digital token, digital security, digital commodity, and digital currency, it'd be hard to get people to define it. I think there'd be a lot of debate about people not even understanding it, right? I bet you we can't get people to agree. For example, you think people will agree on the difference between a digital security and a digital token? What's the difference? It's not well understood. There's no taxonomy. A lot of people think Bitcoin is a digital currency, but in fact, it's really more a digital commodity. Tether and Circle should be thought of as digital currencies. I can't tell you why we don't have a clear regulatory regime. I can't tell you why, because that's politics. It's above my pay grade. I mean, somewhere between the administration, the SEC, the CFTC, Congress, and the Senate and Treasury, they could determine why.
There's a lot of moving parts there, right, as well.
I guess that there's always government, interagency struggles, and there's partisan struggles, and there's struggles between the industry and between the regulators. And so we had some of all of that. And there's a lot of different agendas, and there's a lot of money that's circulating to influence the agendas. And so it's not new, right? I mean, you can find examples of these squabbles in every industry, every decade, for hundreds and hundreds of years. As long as, until you don't have history, as long as there's good history, you'll be able to read about it and debate it. I think that it's not that constructive for us to discuss why we don't have it. Why don't we just talk about what we I have a constructive suggestion, right?
Yep.
I don't know how we get there, but if you wanted the industry to grow, if you said what's best for the civilization, let's start with what's best for the human race, for all 8 billion people. And then we can talk about what's best for the United States or what's best for any given industry, right? But let's talk about what's best for the human race. To harness the power of technology in order to create abundance, in order to reduce friction, in order to improve efficiency, in order to improve productivity. That's what's best for the human race. So how do you do that with digital assets? I think the thing to focus upon is what are the virtues, and they're not that hard to figure out. Here are the virtues. It's virtuous to be able to trade an asset 24/7, 365, friction-free between 20 billion computers and 8 billion mobile phones. That's virtuous. If I can actually move money between here and South Africa on Saturday afternoon, that's virtuous. So digital exchanges are virtuous if you do 24/7, 365. You know, on NASDAQ, you can't sell your Apple stock on Saturday afternoon. But on Coinbase or Binance, you can sell something on Saturday afternoon. So that's a priority. It's pretty obvious that there's a benefit of 24/7, 365 service, a digital exchange. The second thing that's virtuous is digital peer-to-peer transactions. The ability to bypass the exchange and for me to actually send $20 to you without going through Coinbase or Binance, without going through any trusted third party or having the choice of any of 10,000 third parties, right? Choice, right? And so peer-to-peer transaction is virtuous. The ability to self-custody is virtuous. It's valuable to be able to hold your Bitcoin on your hardware wallet or in your head, but one could say it's also equally valuable to be able to hold $100 or 1,000,000 pesos, right? So, well, why not? Why stop there? Why not be able to hold your Apple stock on your hardware wallet, right? Why not be able to hold a bond? Why can't you actually carry your, New York municipal bond in your hardware wallet? So self-custody of assets is a third virtue. The fourth virtue would be the existence of digital commodities. Why can't I have a digital commodity that is that I can self-custody? And Bitcoin is the greatest of digital commodities.
Thank you for watching our video. For more finance content, don't forget to like the video and subscribe to the channel. And remember, when in doubt, just hodl.